Very good evening. Very good evening, and thanks for joining. Welcome, Manish Kumar. Welcome, Vinayak. Our scheduled time is 9 p.m. We'll just wait for 2 or 3 more minutes so that others can join. Just give me a moment. Good evening, Manish. RV, warm welcome. Good evening. We'll just wait for 2 or 3 more minutes so that others can join. Good evening, Vinayak. Arjun Pandey, good evening. And any of you are attending this session for the first time? If any of you are attending for the first time, please type FT. Please type FT. Yeah, Manish Kumar is attending for the first time. Okay. Yes, Manish. Arjun Pandey, Danya Ravi, RV, Vinayak. Good. Now the time is 9:04. We'll start the session sharp by 9:05. We'll just wait for 1 more minute. And I believe all of you are ready for the session with your notepad and pen. If you don't have it, please go and grab it now, because it's going to be a session on financial analysis, right? So there will be a lot of financial metrics which you have to make note of. So please go and take your notepad and pen. We still have 1 more minute. We'll start the session by 9:05. Okay. And please mention from where you are attending this program and name of the bank or organization you are working for, so that we can have idea of mix of audience we have today. From where you are attending this program and name of the bank or organization you are working for. And do not worry about the blurry screen, what you are seeing now. Presentation is going to be altogether different. Okay. Yeah. Manish Kumar from Pune. Warm welcome. Central Bank of India. Okay. Right. Now the time is 9:05. It's time for us to get started. And for delivering this key content, for delivering the key content of this webinar, I have created a video. I'll be playing that. I'll be moderating that. There will be various Q&As during the course of this webinar. So my request is, please participate in all the discussions. Whenever I ask you a question, let however small or silly it be, my request is participate, because when you participate, you are interacting. When you interact, it becomes two-way communication and it will get registered very strongly. Okay, so that's the reason I'm insisting you to interact. And now it's time for us to get started. Just give me 10 to 15 seconds time so that I can come back with the presentation. I'm happy to welcome all of you for this webinar on financial analysis, must skill for every banking executive. I also wish to title this webinar as how to analyze financial condition of business without going through years of mainstream finance education. We are now living in the world of online education. COVID lockdown has opened up the possibilities for online learning. In the past several months, you would have attended various webinars, various workshops, online programs. You would have attended your own organizational internal training. But despite all this, if you have registered for this webinar, if you are attending this webinar, it means you are seriously looking for some guidance, you are seriously looking for some learning resources. I can give you that assurance. That is, your next 60 plus minutes is going to be the valuable time. You will have lots and lots of takeaway in this next 60 plus minutes. What you require is guidance from right person. I can give you enough guidance. I can act as a resource person for you. That's the assurance from my side. Okay, so what is the objective of this program? What is my goal? My goal is basically to help out two types of executives: bank executives and finance executives. They should learn financial analysis. Bankers, they should learn financial analysis because when they sanction loan to a borrower, they do credit appraisal, credit analysis, and in that, financial analysis is the core. So bank executives, especially credit analysts, credit managers, relationship manager, branch manager, credit risk rater, sales manager, they should have a good knowledge of credit and financial analysis. Similarly, finance executives, they should understand how banks are going to evaluate their business. They should understand what are the expectations of the lenders so that they can equip the financial position of their business as well. So that's my goal here. Twin objectives: one is to help bank executives, the other one is to help finance executives. So, shall we begin? Are you ready? If you are ready, type start. If you are ready, type start. Thank you very much. Let's go through a small story. Over a period of 5 to 6 years, I was training thousands of bank executives on topics like credit analysis, financial analysis, working capital, term loan. This is happening for the past 5 to 6 years. But all this did not happen just like that, because I need some foundation, right? How I am teaching this, from where I have learned all this. Let's go back to 2008. In 2008, I joined SBI as credit analyst immediately after my chartered accountancy qualification. I used to say it's just one day before completing my CA program. In campus interview, I was selected. So I had this tag CAN Raja, BCom PGDBA FCA, chartered accountant, and I had that bit of headweight also because completed CA in first attempt, got job in SBI, that too joining as credit analyst. Wow. Okay. So I joined SBI, and first 3 to 4 months that gave me literal nightmares, because the profile of credit analyst, credit analysis was not as simple as what I thought. Because in CA final and all, we have done extensive, complicated study analysis, everything. But when I faced that reality, it shocked me. Day in and day out, we'll be getting balance sheets of corporate customers, business entities. You have to read the balance sheet, you have to analyze, you have to read line by line items, you have to read in between lines, you have to arrive at ratios, you have to analyze, interpret them, then see their cash flow statement, fund flow statement, then do the credit risk rating, then put up a appraisal, then attend committee meetings, get firing, answer the questions, and in the meantime 3 to 4 other proposals will be in queue. Again, you have to analyze different set of customers absolutely with the different business models. So first 3 to 4 months was absolute nightmare. Despite being a chartered accountant, I faced lots and lots of difficulty in understanding what this credit analysis and financial analysis is all about. But thank God, I had good mentors in SBI. They guided me. With their guidance, I was able to pick up things very fast. And within a period of 1 year, I got elevated as team leader of credit processing cell. And over a period of 4 years in SBI, I worked on 250 plus projects. It's 5,000 crore plus size. But what I came across is, despite being a chartered accountant, I struggled a lot. And when I was elevated as team leader, I had newcomers reporting to me who are basically from non-finance background, engineers, science graduates. They struggle in understanding basic accounting. Then comes balance sheet, then comes financial analysis. They had so much of difficulties. So at the time, they used to ask me to teach on basic things. So in the evening time, I used to teach them what is accounting, what is balance sheet, what are ratios, cash flows, fund flows. It started then. It started in 2008 onwards, I can say. And this journey continued for a period of 4 years. Then I came out, I got into CA practice. I had my practice for a period of 7.5 years with more focus on project funding, debt syndication. So again, what I witnessed is, whenever I go to bank, whenever I represent a client, the bankers on the other side were found to be on the weaker position, because client has good knowledge of his business, but bank executive, they are basically shifted from some other department and they have very little idea about what this financial analysis is all about, and many times they fumble. I've seen this. So I started training bankers on credit and financial analysis areas, so that they can approach or they can face their customers very confidently. I started teaching through bank internal training programs. I also empaneled myself as trainer with a few banks. Then I explored technology.
Thanks to technology, today I teach 2 lakh plus students, of which 1 lakh 91,000 plus students are from Udemy portal and 35,000 plus students are from my own portal, CA Raja Classes. Our YouTube channel crossed 1 lakh plus subscribers and my teaching journey was also featured in New Indian Express.
I also received Indian Achievers Award 2021 from Indian Achievers Forum for contribution in nation building through teaching. So, in this backdrop, I wish to ask you once again, are you really serious about learning financial analysis? Are you really serious about learning financial analysis? If yes, please type this ISAFA. I am serious about financial analysis. Just type ISAFA. I'll keep asking you to type out some small things like this. It's basically to ensure we are connected. For me, it happens now and then. Without any notice, my internet connection will go. Okay, so that can happen even today also. So if at all that happens, I would request you to stay back for another 5 to 10 minutes. In the meantime, I can make some other alternate arrangements. Okay, so if you are serious about learning financial analysis today, type ISAFA.
Let's get started with today's presentation. Financial analysis must skill for every banking executive. As a bank executive, why you have to understand financial analysis? Remember one thing, what is the core business of banking? The core business is lending, and how bank takes that decision? They take that lending decision by carrying out something known as credit analysis, and in that financial analysis plays a very significant role. So if you want to rise up in your organizational hierarchy in bank, you should know what is the core business of banking and you should be in a position to take that decision as well. So for that, you have to understand the elements, the factors related to that, and in that financial analysis is very important. Financial analysis of whom? Financial analysis of borrowers, because when they come to the bank approach for a loan, the bank should be in a position to evaluate the customer, then take a decision, and they can do that partly by carrying out financial analysis. And when I say financial analysis, it is analyzing their financial statements, the audited or the past financials, and also their estimated projected financials. And for carrying out that analysis, we are going to use three critical tools. One is financial ratio analysis, two is cash flow analysis, and three is fund flow analysis. Let's get started with financial ratio analysis. I'm going to take you through an example. Let's say there is company A and company B. Company A has reported a profit of 10 crore and company B has reported a profit of 5 crore. If I ask you which company had performed well at this point, what will be your answer?
It's a simple question. It's like taking a baby step, but still, I want all of you to participate. Some of you may even feel information is inadequate to take a decision, but let's take that baby step. Let's take that baby step. You have to say which company is performing better. Yes, I could see answers coming like most of you are saying yes, yay, yay, yay. So I could see more of yay. And very few said can't take a decision now. And so the conclusion, I'm going to make it like this. Majority said A and very few said they need some more information. Okay, let's see in what direction this goes. Let's see. Yeah.
Most of you would say company A, right? Because company A has reported a profit of 10 crore. But if I supply you one piece of information, that is the sales achieved by this company, company A has achieved a sales of 100 crore and company B has achieved a sales of 25 crore. And if I ask you once again, which company has performed well now, what will be your answer?
Yeah, earlier, at least some of you would have felt that, or you have expressed also that information is inadequate to take a decision, and I'm literally forcing you to take a decision. So now this time I have supplied something important and relevant information. And remember, earlier majority of you said A. Majority of you said it's company A that is performing better. Now let's look at the kind of shift that is going to happen. And I know it's a very elementary question. This is not rocket science. I'm not teaching you something hi-fi here. I'm not teaching you the advanced concepts in financial analysis. We are just taking our baby step, but you are going to see that kind of impact financial analysis can have on your decision. That's what I'm trying to bring out here. And I could see answers coming like, so what I could see is now majority of the answers are coming in favor of B. I think it's a drastic shift. Majority of you are saying B. Why this happened? Why this happened? See, earlier you took a decision based on raw data. That's why majority selected A. But when I supplied you that additional piece of information, that critical and logical information which you can relate with, you did that analysis. I believe you did that meaningful analysis, and I believe you have taken a quality decision. How many of you agree with me that you have taken a quality decision now? Because earlier you chose A, but now you have selected B. And how many of you believe that B is actually performing better? If you believe yes, please type yes. And if you changed your opinion, please type me. It means you have changed your opinion. It's a confession. Do that confession. It's good because you are learning now. Okay. See, even now there are many other factors. We cannot take a decision just by looking at the profit alone. Okay. There are many other factors, but let us take our baby step. We'll take about step one, step two, then we'll go deeper and deeper. But given this information, now we can conclude that B is actually performing better than A. Earlier, majority of you said A, but many of you could change your decision. It means now you have taken an informed decision. Earlier decision was taken on the basis of raw data, but now it is analytical information, and you have taken a quality decision. And that's the power of financial analysis. And that's why I maintain financial analysis as the core. So once again, with this note, I welcome all of you for joining this webinar, and let's get into the world of financial analysis. And this is the way in which we are going to learn today. And if you find this way of learning interesting, please type cool, C-O-O-L. Or if you find it super cool, you are welcome to type super cool as well. But let me admit, it's not rocket science. These are all simple concepts. I just got the privilege of introducing them to you. Yeah, thank you so much. Thank you for all those cool, super cool comments. Let's get into the discussion.
There will be a drastic shift, right? Because earlier most of you would have favored company A, but now majority of you will be favoring company B. What happened? When you looked at the standalone figure, it was deceiving because profit of 10 crore looked better than profit of 5 crore. Yes, that's true. But when you gone deeper by comparing the profit with sales, you were able to calculate the profit margin. Company A has reported a profit of 10 crore on 100 crore. It means they have a profit margin of 10%. Whereas company B has reported a profit of 5 crore on 25 crore. It means they have profit margin of 20%. So what's happening? Company B has performed well. In this case, what we have done is we have compared the profit with sales and we have calculated this ratio. Profit by sales into 100. That is what we have calculated as profitability or profit margin. Okay. So ratios are basically a relationship between two numbers which are created in a logical way. Yes, we related sales and profits, and it's a relationship between two numbers, and there was a logic in relating the sales and profit because we can measure profitability. We related current assets and current liability to numbers, and the logic is it helps us to understand the liquidity. Okay, so ratios are relationship between two numbers which are created in a logical way, and it will help us to understand the past, present and future performance, and it will also help us to understand the strengths and weaknesses of businesses. Yes, by looking at the profitability ratio, we were able to understand like which company is performing well. So we have understood the strength and weakness. So like that we can give many variations. Okay, so that's about ratios, and we are going to understand the ratios by looking at its classifications. Ratios are broadly classified into four categories. They are liquidity ratios, capital structure or leverage ratios, activity ratios, and profitability ratios. First, let's get started with liquidity ratios. Liquidity is basically ability of the business to meet its short-term expenses, short-term obligations without difficulty. At this point, I just want to bring the balance sheet here. So those who don't know what is balance sheet is a simple statement which will show from where and all money had come for business and where and all that money had been used. Okay, so for business, money can come from owners, we call it as equity. Money can come from outsiders, we call it as liabilities. When money comes from outsiders, it can come with an obligation to pay within 1 year or pay after 1 year. If it comes with an obligation to pay within 1 year, we call them as short-term liabilities because we have to pay within 1 year. And using these money, which are basically raised as repayable within 1 year, which we call them as short-term liability, we can use this liability money to create asset, that is short-term asset. But if you look at this, the short-term assets are greater than short-term liability. How it is possible? Because the short-term what is raised in yellow box is smaller, but short-term assets are larger. It means this short-term assets could not have been created without the support of some long-term funds, because only a portion of short-term assets are funded by short-term liabilities. It means there got to be some remaining funds which have been used in creating short-term assets, and that's how it should be for every business. Short-term assets should be greater than short-term liabilities, because short-term liabilities are those liabilities which you have to repay within 1 year, and for repaying that you need resources. Resources will be in the form of short-term assets, so the resources should always be greater than the obligation. That's why I've I've captured the short-term assets as larger size and short-term liabilities as smaller size. That's how it should be for an ideal business. Okay, right. Now, to understand this liquidity concept, let's first digest this fund utilization principle.
Yes, whatever you see on screen, I mean it. This fund utilization principle is going to be the very, very important segment of this webinar. I would call this segment as the savior for banking system, entrepreneurs, employees, everyone. Such a powerful principle. Do not miss even a single point. If you don't have your notepad and pen, please go and grab it, because it's such a powerful principle which you will agree for after the end of this explanation. Okay, so let's continue.
Whoever attending this webinar, whether you work in a bank or whether you are an entrepreneur or a finance manager or a chartered accountant or a cost accountant, okay, please take this principle to your heart, to your mind, and try to teach this to as many entrepreneurs as possible, because several businesses fail because of not understanding this principle. Okay, now listen. I said money for business can be raised from the owners, we call it as equity. It can be raised from outsiders, we call it as liabilities. And this liability can be short-term liability, and these short-term liability can be used for creating assets. They are called as short-term assets. But here if you look at short-term assets are greater than short-term liabilities, it means some portion of short-term assets are funded by long-term funds. I call them as long-term liabilities and equity. So this gives rise to the understanding that equity, the money contributed by the owner, is always long-term, and other long-term liabilities. Liabilities means repayable. So it can be a term loan, it can be a debenture. Okay, right. So if you look at the composition here, short-term assets are created using an entire portion of short-term liabilities and some portion of long-term funds, I call it. So you still have some more long-term funds which can be used for creating long-term assets. Now comes the fund utilization principle. If you are raising short-term funds, you can use it for creating short-term assets. It is good. If you are raising long-term funds, you can use it for creating long-term assets. That is also good. If you are raising long-term funds, you can use a portion of long-term funds for creating short-term assets. That is considered as ideal. But one thing that should never ever happen in any business is never ever use short-term funds for creating long-term assets. Never ever use short-term funds for creating long-term assets. Why do I say that? Short-term funds are raised with a promise that you will repay within 1 year. And if you want to repay within 1 year, you should have invested that money in short-term assets, because only those assets can be converted into cash within a period of 1 year, so that you can use that cash to pay back the short-term liability. On the other side, if you use the short-term liability on creating long-term assets, by very name, by very nature, they are long-term assets. It means those are all the assets which cannot be converted into cash within a period of 1 year. So you borrowed with a promise you will repay within 1 year. So when the due date approach, if you look back, you will not have short-term assets. What you will have is only long-term assets. Long-term assets by very nature, by very definition, they cannot be converted into cash within a period of 1 year. Then you will carry sorry figure, or you will carry sorry face with your lender. Imagine that short-term liability, that short-term fund was given by a banker in the form of a cash credit or overdraft, and when they demands the repayment, and if you don't have a matching short-term assets because you have already used that money in long-term assets, what's your position? You will not be able to sell that long-term asset. But this lender, the banker who gave you that cash credit, who gave you that overdraft, will hardly wait for 90 days. 90th day they will classify the account as non-performing asset, and they will go for legal recovery measures, and that becomes the beginning of end of a business. Okay, so understand, diverting the short-term funds for long-term purpose is suicidal. Most of the business, they do not realize this. They think all money are same, but short-term money have very high pressure because they have to be settled in the short-term period. But long-term money, they are cool because you have to settle them over a period of time only. Just imagine you take a home loan, you have to pay over a period of 20 years. Your obligation will also be manageable. But for that entire home loan amount, if you go and take an overdraft, imagine the kind of pressure. Will you be able to settle that entire home loan amount within a period of 1 year? It will not happen, right? So if at all you raise an overdraft equivalent to home loan amount, and if you put that in constructing a house, it means you are not constructing a house, you are constructing something else which I don't want to mention, because it's going to put you in trouble. It will give you sleepless nights. Okay, so never ever do this. Let me give some numbers so that we can understand it better. I've raised short-term funds of 100 million, and I've used that funds to create short-term assets of 70 million only. So here comes the problem. I've raised short-term funds of 100 million, but the short-term assets what I have created out of it is only 70 million. So the question is, what happened to that remaining 30 million? And the answer is very obvious. It is not in short-term assets. They are in long-term assets. They are in long-term assets. So what I've done here, I've diverted the short-term funds of 30 million for long-term assets. And I've also raised some long-term funds of 70 million, which I've used for creating long-term assets of 70 million. So my total both sides are 170 million. But here, what happened is I've raised 100 million, of which I have spent only 70 million for short-term purpose. Then I did that blunder, unpardonable mistake of diverting the short-term funds for long-term purpose, 30 million. This is going to put this business in serious trouble, because the lender, whoever have given that 30 million, they will come and ask for the payment within period of 1 year. And for paying them, I don't have short-term assets, because the existing short-term assets is only 70 million. For that, there is a corresponding obligation of 70 million. Whereas for the remaining obligation of 30 million, I don't have short-term assets. What I have is only long-term assets. Long-term assets I cannot sell just like that. It will take its own time, and those lenders will not wait till I settle my long-term assets or till I sell my long-term assets. Okay, that's where the problem starts, because bankers are permitted to wait only for 90 days. Then they have to go for legal enforcement. If it is a supplier's money, probably he'll give you 2 or 3 calls, then he'll go for legal enforcement. That's where the problem starts. Okay. So here there is a diversion of 30 million, and this 70 million they have used for a long-term purpose only. That's okay, but the blunder, the mistake, the sin what was committed here is diversion of 30 million short-term funds for long-term purpose. Okay.
It's this principle which was not taught to entrepreneurs, not understood by entrepreneurs, and because of that, several business lands into trouble. Business runs into trouble because entrepreneurs were not taught about this. They are not cautioned about this. Had this principle been instilled on their minds that committing this is a mistake, this will put them in trouble, we could have saved several thousands of business. But by the time entrepreneurs realize that they have committed this mistake, they will be in deep trap. Then they try to come out of it, but chances of coming out of it is very, very remote unless and until they line up some long-term funds to substitute this immediately. In my opinion, it's a powerful principle, but given very less weightage, and because of that, businesses are collapsing, and this is even shaking the banking system. So I call it as powerful principle, and I have a question for you. How do you find this principle? Do you find this principle useful? If you find this principle useful, please type useful. Or if you find this principle super powerful, please type super powerful. Because it's such a powerful principle, but not given due weightage. Even Reserve Bank conducted a study to understand why business units are becoming sick, why they are becoming non-performing assets. And do you know what was the reason they identified? They identified that only 5% of businesses are failing because of poor sales, high competition, technology non-upgradation, quality matters, HR issues, legal issues, and those is only 5%. It means remaining 95% of the businesses have failed only because of the single reason called diversion of short-term funds for long-term purpose. So understand this principle, and if you find this principle useful, if you find this principle super powerful, shall I place a request with you? It's a request where you have to act on. If you're permitting me, please type yes. Please type yes, because it's a request and you have to act on the request. Yeah, thank you so much. The request is you just have to take this message forward. Meaning you have to teach this principle. Please teach this principle to the entrepreneurs you know. Please teach this principle to your friends and colleagues who are connected in banking and finance. Take that 2 or 3 minutes just to teach them. Take it from me. It will create a wave kind of impact. It can safeguard several businesses, not only businesses, it's a dependence like employees, bankers, various stakeholders, everyone. Such a powerful principle. So my question to you is, will you teach? Will you teach? If yes, please type I will teach. Please type I will teach, or simply type IWT. Simply type IWT. Everyone can be saved if they can appreciate the crux of this principle. And when you teach, please place the same request. Ask them to teach it to someone they know. In this way, let this message reach masses, because this is a kind of a virus and it happens mostly on account of ignorance. And people will realize only after committing this mistake. And this is not only applicable for business, but also for our own personal life. And yes, I could see many of you taking that oath. Please see to that you teach at least one person in the following week. And thank you. Let's continue with the discussion.
With this understanding, let's get into liquidity ratios. Liquidity ratios are broadly classified into 4 ratios, and in this webinar we are going to focus on the first one that's very important, that is current ratio. So current ratio scenario should look like this, because we know how to calculate current ratio, which is current asset by current liability. Okay, but current ratio scenario should be like this, that is current assets should be greater than current liabilities, and we calculate the current ratio like this, current asset by current liability. If current assets are greater than current liability, it means the resources are greater than obligations. Okay, let me take you through 3 scenarios. Look at the scenario 1, where the current liabilities are given. Okay, so this is total current liability, which is 300, and the resources that are available to settle that obligation is available. Okay, so the obligation is 300, resources are 600. So I think here the liquidity position is really comfortable. If I plot this in a form of a graph, the red bar indicates the resources, blue bar is the obligation, and here you can see there is a comfort zone. We call that as positive net working capital. How I have calculated? I've compared the current assets with current liabilities. So there are excess current assets. Excess current assets means that portion of current asset is not created by current liability, but they are rather funded by long-term funds. The portion of long-term funds used for creating current asset, we technically call it as net working capital. So if a business is having positive net working capital, it is a good sign, because to that extent that business will not have liquidity pressure. Okay, here they have 600 million as current assets and 300 million is the current liability. So they have pressure only for 300 million. For the remaining 300 million, they don't have pressure, because it can be settled over a period of long time. Okay, that's what we understand when current ratio is like this, like 2:1. Let me give you another scenario. Here the current liabilities is same, and current assets there is a difference. Okay, look what's happening. Current liabilities are 300 and current assets were also 300. So you have an obligation of 300 million. For that you have resources of 300 million. It looks like a perfect scenario, but that's not the case. Okay, because let's say the bank CC has become due. This 100 had become due, and you can settle that using your cash and bank balances. Then when this 200 becomes due, what are the assets you have? Only the stock and receivables. Let's say the receivables are getting converted into cash. That's good. So out of 200 you settle 100, but still you have another 100 pending. So what will you do? How will you manage? Because you cannot settle your suppliers with the stock. You purchase stock from them. You cannot pay them in stock. You have to pay them in cash, and you cannot tell them please come and take back my stock. If you say so, then that becomes end of the credit business for you. You will not get credit from any suppliers in future, because that supplier will take care of the task of negative marketing for you. Okay, so that's why I said this scenario, even though it looks like an ideal scenario, it is not ideal. It's not an ideal scenario, because some of the current assets will not come for rescue when you want them very desperately. Okay, let me take you through scenario 3. Scenario 3, and here the current liabilities are same, whereas current assets are comparatively lesser. Look at your current liabilities, it is 300. Look at your current assets, it is 200. So here you can see the problem. You have to settle 300 million within a period of 1 year, and for settling that you have resources of only 200 million with you. You have to settle 300 million, but you have only 200 million. So how will you manage that 100 million? That's the question. Okay, that indicates this business is going to land in trouble, number one. Number two, this will also communicate their financial discipline. They've raised 300 million short-term funds. They should have created short-term assets of 300 million, but what they have created is only 200 million. So the question is, what happened to that remaining 100 million? It's very obvious, they have diverted it for long-term purpose, and they have committed that sin or blunder of diverting the short-term funds for long-term purpose, which will put that business into serious trouble. Okay, so if I put that in a form of a graph, look, the blue bar is the obligation and red bar are the resources, and clearly you can see there is a shortage, and to that extent this business is in a danger zone, because here the resources are lesser than the obligations. So when your current assets are lesser than the current liability, that is current asset minus current liability, obviously your net working capital will be negative. You will have negative net working capital. Okay, so let's capture all the three scenarios here. Scenario 1, current asset 600, current liability 300, so the net working capital was 600 minus 300, 300. Net working capital means the long-term funds which were used for creating current assets. So here if you see 300 long-term funds and 300 short-term funds put together, current assets of 600 was created. And if I look at the current ratio, it is 300 by 600, it is 2:1. In scenario 2, there is no long-term fund contribution at all, and the ratio is 1:1. And in scenario 3, 200 is the current asset, 300 is the current liability. It means there is a negative net working capital. Negative net working capital indicates a diversion of short-term funds for long-term purpose. So whenever you come across a negative net working capital, it means there is a diversion of short-term funds for long-term purpose. And whenever there is a diversion of short-term funds for long-term purpose, the current ratio will also be below 1. Here 200 current asset divided by current liability 300. 200 by 300, you are going to get the current ratio as 0.67:1. It means for every 1 rupee obligation, they have resources of only 67 paise, which clearly shows there is a shortage. Okay, and this also means that there is a diversion of fund. At this point, I want to ask you a question. Since some of you or most of you are working in bank, what is the minimum current ratio insisted by your bank? What is the minimum current ratio insisted by your bank?
Yeah, please type what is the minimum current ratio insisted by your bank. I could see answers coming like 1.33. Yeah, different set of answers. Let me just check. Yeah, I could see 1.33, 1.171, 1.34, 2:1. Yes, so what we can see is it's differing bank to bank. Yes, bank to bank, this would differ based on their risk appetite. Within bank itself, based on borrower profile, whether the borrower is into trading, manufacturing, services, it could vary. It could also vary based on the industry. Okay, so that's about the different level of current ratios.
Shall I take a couple of minutes to explain the logic behind a minimum current ratio of 1.33? Why banks are insisting on minimum current ratio of 1.33? Shall I explain?
Can you all just type BIO? BIO stands for bring it on. It is also our internet connectivity check. I could see many of you said minimum current ratio is 1.33. So if you're typing BIO, it means you can hear me, you can see the presentation. Yes, thanks a lot. Thanks a lot. And one assurance I will give you, this explanation will open up the logic behind minimum current ratio of 1.33. So whoever working on current ratio, and if you didn't know what was the logic of 1.33, or for that matter, whether it is 1.1 or 1.5, this explanation will open up the logic. But once again, I admit it's not a rocket science. It's a simple concept. This explanation will beautify your understanding, and with that, you will fall in love with financial analysis. Let's see.
Okay. Let's say I have current assets of 100 million and current liabilities of 75 million. And with this information, if I calculate the current ratio, it will be current assets by current liability, and it is 100 by 75. So it is 1.33. 100 by 75, and it is 1.33. So what I can infer is When my current ratio is 1.33, it means 75% of the current assets are funded by current liabilities. And what is even more important is the remaining 25% of the current assets, that is current asset minus current liability, the remaining 25% of the current assets are funded by long-term funds. Funded by long-term funds, we technically call them as net working capital. So when the current ratio is 1.33, we can safely conclude that 25% of the current assets are funded by long-term funds. It means there is a 25% long-term fund contribution for creating current assets, and that's what most of the banks stipulate as margin for working capital. For example, if you go and check the sanction letter issued by most of the banks, they would have stipulated 25% margin for working capital credit facilities. Even if you look at the Tandon Committee recommendation for arriving at working capital, they said that 25% of the current assets have to be funded by margin, and it is only the remaining 75% banks can explore funding. Okay, it means there should be a 25% contribution of long-term funds for creating current assets, and that is verified or that is checked through current ratio. If current ratio is 1.33, then there is 25% contribution. If it is greater than 1.33, then there is greater than 25% contribution, and if it is less than 1.33, then there is less than 25% contribution, and that's the reason most of the banks insist on current ratio of 1.33. Okay.
Yes, this is the logic behind minimum current ratio of 1.33. So how many of you find this as bulb on moment? Bulb on moment means it has opened up the logic for you, which you didn't know all these days. If it is a bulb on moment, please type bulb on or simply type BO. I'll take that as your certificate of appreciation for my teaching skills, which I love at most. Yes, thank you. I could see many of you are saying bulb on. It means you are learning in this session. Bulb on indicates there is a learning experience. Good. Thank you. Let's continue.
Now let's move on to capital structure ratios. Under that, there are three ratios, but here we are going to discuss about what is important from bankers' point of view, that is debt to equity ratio. In debt to equity ratio, what we'll be doing is we'll be comparing the debt with equity to understand the long-term solvency of a business. Let me take you through a balance sheet. I'm just going to show you the left-hand side, that is the equity and liability side. Look at this, shareholder funds are 100, bank loan is 100, debentures are 100, and sundry creditors are 200 million. It means this business has raised 500 million from four different parties. Owners 100 million, from bankers 100 million, from debenture holders by issuing debentures 100 million, and from suppliers, sundry creditors 200 million. Now what we have to do, what we are trying to understand, it is debt equity ratio. So we have to compare the debt with equity. Equity is the owner's money. In this case, it is this 100, and debt is the sum of all the three. We call them as outside liabilities, and it is 400. So let's compare the debt with equity. Debt is 400, equity is 100, and the formula for debt equity ratio is debt divided by equity, 400 by 100. We get the value as 4. Let me take you through a scenario, a 3-case scenario, so that we can understand it better. The first scenario what we are discussing now is total outside liabilities of 400, equity, the money contributed by the owners, as well as the profits that are attributable to them put together, we call it as equity, 100. So if I calculate the debt equity, that is total outside liabilities divided by equity, 400 by 100, I get the value as 1, and we express it as 4:1. It means for every 1 rupee contributed by the owner, this business has borrowed 4 rupees. For every 1 rupee contributed by the owner, this business has borrowed 4 rupees. So what we can understand, if this business is raising 5 rupees, 4 out of 5 rupees is by outsiders and 1 out of 5 is contributed by the owners. That's what you see here. Outsider share are 4 out of 5, that is 80%, and owner share are 1 out of 5, that is 20%. So what's happening here? In this business, owner's stake is very less, whereas outsiders have contributed more. And I see this as highly risky proposition. Because this 80% of the funds which had come into the business would not have come free. They would have come with a cost. And these costs have to be met, let whatever be the situations surrounding the business or affecting the business. Because they are all fixed cost. Look at this, in this case 400 million they have raised as debt, and they have to pay interest, they have to pay principal, let whatever be the market condition. Only in rare exceptional circumstances the regulators will step in and give direction to the banking system to not to demand for payment for some time, like what we have COVID. Reserve Bank came and said give them moratorium for 3 months, then give moratorium for another 3 months. Okay, but it will not happen every year. It happens only in rare situations. So in this case, this 400 million, they have an obligation, and that has a fixed cost in the form of interest, in the form of loan principal repayment, and they have to be met. And if for some or the other reason, if their sales comes down and if they are not in a position to meet that commitment, meet that obligation, this business will get affected to the core. Because whoever have given money, they'll not wait for long. They go for legal recourses, and that could come as a big blow for the normal operations of this business. Okay, so that's why I say 4:1 is a highly risky scenario. Let me give you a second scenario where the outside liabilities are 333 and equity is 167. I chose these numbers to convey an important message. Because look, the total funds are 500. Here also it is 500 only, but I've chosen a different proportion. The proportion works like this. If you take the debt 333 and if you divide it by equity of 167, you get the debt equity ratio as 2. We express it as 2:1. It means for every 1 rupee contributed by the owners, this business is borrowing 2 rupees. It means if this business is raising 3 rupees, 2 out of 3, that is 2/3, that is 67% is coming from outsiders, and 1 out of 3, that is 33% is coming from owners. And for me, this is much better than scenario 1. In scenario 1, outsiders contribution are 80%, where in scenario 2 it is only 67%. To that extent, there will be reduction in fixed cost as well. In scenario 1, owners have contributed only 20%. In scenario 2, owners are contributing 33%. I see that as a good sign, because owners will be investing more of their money when they see their business is more promising. Let me take you through scenario 3, where total outside liabilities are 250 and equity is 250. Again, I have maintained the total as 500, but I've changed the proportion. So what is the debt equity ratio now? 250 by 250, it is 1:1. It means if this business is raising 2 rupees, 1 out of 2, that is 50% share, is coming from outsiders, and 1 out of 2, 50% share is coming from owners. And this is much better than the first and the second scenario, because here the outsiders share have come down, and as a result the fixed cost related to that will also come down. Fixed commitment, fixed obligation will come down. This will reduce the burden, it will reduce the pressure on the business. And owners are investing 50%. It means they know this business is very much promising. That's why they are committing their money. So what is an indication? The indication is scenario 1 attracts high financial risk. Scenario 2 we say ideal, and scenario 3 is the best. Okay, so this ratio, that is debt equity ratio, or we call it as TOL, total outside liability, by TNW, that's basically the equity. Okay, that communicates the long-term solvency. Businesses with a high risk, businesses with high level of ratio will have a high financial risk, and because of that, it's possible that during recessionary market conditions, those businesses may not be able to withstand, they'll get washed away. Because when their sales comes down, and if their fixed cost is going to remain fixed only, it means the impact is reduced sale, higher fixed cost, so the profit will turn out to be loss, and that business will have its natural death. Okay, so that's what we are trying to understand through this debt equity ratio. So whoever working in bank, you will know, because you will be carrying out credit rating of the customers, and in my experience, the highest weightage is given for the single ratio, that is debt equity, or we call it as total outside liability by tangible net worth.
Yeah, that's about debt equity ratio. And here, when I say debt equity ratio, I mean this TOL by TNW, that is total outside liability by tangible net worth. The reason why I'm giving this explanation is because some banks will use the term debt equity, some banks will use TOL by TNW, and in some banks, there will be a combination. They'll use TOL by TNW for evaluating the business as a whole, and they'll be using debt equity ratio only with reference to term loan. Okay, for term loan, they will compute debt equity ratio. So here, my explanation of debt equity ratio is TOL by TNW. Now, a question to all of you. What is the maximum TOL by TNW ratio acceptable by your bank, tolerable by your bank? Maximum means your bank will not go beyond that. Okay, I could see like 4:1. 4 means 80% can be the overall debt or liabilities. It means 20% should come from owners. I could see Sridatta saying 5:1. Then 2:1 is coming. 2:1 means what? 2/3, 67% can be outside liabilities. It means 33% should come from owners. So here also what we could see is bank to bank, this could vary based on the risk appetite, and within the bank also based on the borrower profile, whether the borrower is into trading, manufacturing, services, and depending upon industry also, it could vary. So the message is we cannot have a one size or one ratio fit all approach because it's going to vary based on the profile, based on the bank risk appetite. So what you have to do when it comes to practical application of this ratio, the message or the advice is please be guided by loan policy guidelines of your bank, because loan policy guidelines of your bank is your charter, and that will tell you how you should handle that scenario. Here I have explained the ratios. I have explained what they mean, how you have to interpret it. But to what extent you should go or what you should insist as minimum, that should be ruled or governed by loan policy guidelines of your bank. And if that makes sense for you, please type MS. Please type MS.
Next, we'll move on to coverage ratio. In that, first, I'm going to explain debt service coverage ratio. We call it as DSCR. This ratio is calculated to measure the repayment capacity of a borrower when he approaches a bank for a term loan. So how repayment capacity is measured? It is measured by finding out the cash profit available for debt service and comparing that with the repayment obligation for every year, which is interest plus principal. So here, how this cash profit available for debt service is computed. Let me show. What we do is we take profit after tax and dividend. With that, depreciation will be added back. Reason being, depreciation is a non-cash item. Not even a single penny cash goes out in the name of depreciation. Okay, since we want to find out cash profit, what we do, we add back depreciation, because while arriving at the profit after tax, this depreciation was subtracted as an expense, but no cash goes out, so we are adding back depreciation. Then we are also adding interest, not because it is a non-cash item, but because we want to know what is the cash profit available for paying interest and principal. If you want to know what is the cash profit available for paying interest and principal, you cannot take cash profit which is after paying interest. Okay, because we are starting with profit after tax and dividend, right? This profit after tax was arrived after subtracting all expenses, which also include interest. So let us add back that so that it gets nullified. So by doing this, taking profit after tax and dividend, and by adding depreciation and interest, we arrive at cash profit, and this is the formula followed by most of the bankers. Let me take you through an example so that you can understand it better. Look at the statement. This particular business has made a sales of 1000. Their direct cost is 500. Their gross profit is 500. Operating expenses are 100. Depreciation is 100. Interest on loan is 100. So from sales, direct cost was deducted 500. They had a gross profit of 500, and we are deducting three expenses. So from gross profit, when we deduct all the three expenses, we get the profit before tax. So 500 minus 300, you have as 200. From that, let's deduct tax at 50%, which is 100. So you get profit after tax of 100. Now listen. For computing debt service coverage ratio, what we have to do? We have to take profit after tax. With that, we have to add back depreciation and interest on loan. In this case, there is no dividend, so we are starting with profit after tax. So 100 plus 100 plus 100, 300. This becomes the cash profit. This cash profit have to be compared with the repayment obligation, which is basically interest on loan of 100, what we have seen, plus interest on principal I am giving you, which is 100. So what is the total obligation? 200. What is the cash profit? 300. Now we can find out debt service coverage ratio. DSCR is equal to profit after tax and dividend plus interest on term loan plus depreciation divided by interest plus principal. In this case, it is 300 divided by 200 and you get as 1.5 times. You get the value as what? 1.5 times. And what does that communicate? For every 1 rupee loan obligation, which is interest plus principal, this business is having a cash profit of 1 rupee 50 paise. So it looks good, right? Because for paying 1 rupee, they are having a cash profit of 1 rupee 50 paise. It means from 1 rupee 50 paise, 1 rupee can be paid off. Still 50 paise is available with that business. They can use that 50 paise for supporting their working capital requirements. Okay, right. Now I want to ask you a question. What is the minimum DSCR insisted by most of the banks? If you're working in a bank or if you are exposed to this concept, please give your answer. What is the minimum DSCR insisted by most of the banks?
Yes, I could see answers coming like 1, 1.5, 1.33, 1 also there. So we boost 1, 1.5, 1.25. Anyone working in public sector bank? Because they are mostly, you will see like 1.75, right? Anyone with 1.75 ratio? Rupinder Singh 0.8, I doubt. 0.8 means you are saying 80 rupees is sufficient for paying 100 rupees? I doubt that. Yeah, Deepak, Bank of India 1.5. Okay, right. Okay, fine. Let's continue.
Okay. 1.1 will be insisted by the banks who are ready to take risk. Okay, because 1.1 is a very small ratio. If they are okay with that, it means they are willing to take more risk. It means the side effect is the interest rate will be very high. 1.5 is accepted by most of the bankers and 1.75 is insisted by public sector banks, okay, who are very conservative. They'll be insisting a DSCR of 1.75. Now let me take couple of minutes to explain the DSCR rationale, why some banks are insisting on 1.75 times or say for that matter even 1.5 times. Why banks are insisting on DSCR of 1.5 or 1.75 and not just 1? Because if DSCR is 1 for paying loan obligation of 1, they are having resources of 1, why not banks stop with that? Why they are insisting on 1.5 or 1.75? Shall I explain?
Yeah, can you all just type BIO once again? It stands for bring it on. It is also our internet connectivity check. And this will be something you will really enjoy and cherish because many of you had bulb on moment in current ratio, right? It will be even more brighter in this. Let's see.
Okay, let me explain the rationale behind this minimum DSCR. Look at this. If DSCR is 1.75 is to 1, it means for every 1 rupee obligation there is a cash profit of 1 rupee 75 paise. So from 1 rupee 75 paise, 1 rupee can be paid and what is left with the business is this 75 paise. This 75 paise is the profit after tax, after dividend, after paying interest and after paying principal also. So it basically goes as retained profit, and this retained profit will go to a head called reserves and surplus in balance sheet under the head equity. And equity along with other long-term liabilities will become long-term funds, and that long-term funds can be used for supporting working capital margin. If this does not make sense for you, worry not. Look at this. Your statement of profit and loss only communicates what is profit. From that we calculate cash profit. Then we compare that with the obligation and we arrive at DSCR. And if DSCR is 1.75, it means out of 1.75, 1 can be paid, 0.75 can be retained in the business. And I told you that this retained profit will go to balance sheet under the head reserves and surplus. So now this reserves and surplus along with capital will be called as equity, and this equity along with the long-term liabilities will be called as long-term funds. These long-term funds can be considered or can be used for creating long-term assets. I repeat, these long-term liabilities can be used for creating long-term assets. But if you look at the proportion, look, you have so much of long-term funds, but only a portion of long-term funds has been used for creating long-term assets. It means there is some surplus. So what's going to happen here? This business is also raising some short-term funds. It is creating short-term assets. The short-term assets are more than the short-term funds. How it was made possible? Because short-term funds are very small, but short-term assets are much bigger than that. It was made possible because the remaining surplus of long-term funds, has been utilized for creating this short-term assets. Now try to link with our fund utilization principle. We said a portion of current asset should be funded by short-term funds and another portion should be funded by long-term funds, because I said I marked it as ideal. Utilizing the long-term funds for creating short-term assets is ideal because that is going to relieve the business from liquidity pressure. So if a business is having a DSCR of 1.75, that 0.75 gets retained in the business. It gets retained, it becomes part of long-term funds. So that long-term funds, after being utilized for creating long-term assets, there will be some surplus. That surplus will in turn get utilized for short-term assets, and this is what we call as long-term funds used for creating short-term assets. Technically this is the net working capital. Okay, so it is not that mere profit along with capital along with long-term liability, they all become put together long-term funds, and they are actually supporting short-term asset creation. So this is the logic. I hope you would have understood.
Yes, this is the logic behind DSCR of 1.75. This is the logic why banks are very particular about the level, like 1.75, let it be 1.75 or 1.5 or 1.1. And if you got that logic clear with this explanation, please type bulb on or simply type BO. You can also type bulb on if you are deriving value from the session, if you have learned something critical, meaningful, sensible, something important for your job, something important for your career, please type bulb on. I'll take that as your certificate of appreciation. And thank you. Thanks a lot. What you have seen now is only the tip of the iceberg. What you have seen now is only the tip of the iceberg. But the best part is you have understood whatever I have explained so far. Thank you very much. The reason why I say it's a tip of the iceberg is because in reality, when you do the credit appraisal, when you do the financial analysis, you have to read balance sheet line by line. You should focus or put your attention on every item in balance sheet. You have to analyze various set of financial ratios. There will be liquidity, solvency, profitability, return on investment ratios, various set of ratios. Then you have to study the cash flow statements in depth. You have to focus on item by item items. You should see where they generated money, where they have used, how they have used. Then you should also study their fund flow statement in depth and again in between the lines to identify whether any fund diversion have taken place. Then you should develop special skill for assessing the working capital requirement of the borrower. Here you got to empathize with the borrower, but at the same time you should also protect the bank's interest. Next, you should be able to put up a comprehensive loan proposal if a borrower comes for a term loan for putting up a project, because this requires viability study. You have to look into their repayment capacity, DSCR, fire, break even, sensitivity, and so on. Next, you should also be able to work seamlessly on CMA report, the basic Excel document which captures the past financial data as well as the current estimate and projection, and from this only all kind of analysis will happen. Next, you should be able to arrive at credit risk rating for the borrower. You should be able to come across different types of business entities, business models profile, and you should also be able to understand the forex impact on import export transactions. So what all this means? All this means you got to learn more, right? So how many of you are really ready to learn more? Because once again, I reiterate, what I have showed you today is only tip of the iceberg. So how many of you are interested in learning more? If you are really interested in learning more, if you want to take this journey to the next level, if you want to improve your skills that is required for your job, and that's the fundamental for your banking career, then type ILM. ILM stands for I am interested in learning more. ILM stands for I am interested in learning more. Whoever interested, please type ILM. Thank you very much. Can I have your permission to introduce the courses which I have published for bankers, which will solve all the problems we discussed? If you're permitting me, just type yes. Just type yes. I'll take that as your approval.
Financial and Credit Analysis Mastery Bundle. It's a bundle of course I have created for financial and credit analysis purposes. To start with, we have course number 1, our bestseller course, Banking Credit Analysis Process. By taking this course, you will get a complete picture of banking credit analysis process, starting with credit analysis, financial analysis, ratios, cash flows, fund flows, working capital, term loan, and so on. It's basically 30 plus sections, 200 plus lectures. This is one of our best selling course and it's included in this package. Then comes course number 2, how to carry out financial analysis as a banker. This course focuses exclusively on financial analysis, covering how to carry out financial analysis through ratios, fund flows, and cash flows. Then we have course number 3, how to carry out term loan appraisal and analysis as a banker. This is a course which is going to take you through the technical process of term loan appraisal and assessment, because here you have to understand the techno-economic viability of the project. You should arrive at the cost of project, means of finance that requires a different set of approach. You should understand the production factors of a project. You should understand the technical analysis involved in term loan appraisal and assessment, and this course will take you through that. Then we have course number 4, how to prepare CMA report for bank loan. CMA report is basically that Excel spreadsheet which is going to capture the past financials, present, estimate and future projections, and it's by looking at the indicators generated out of this CMA report, bankers are going to take critical decision. So in this course, through 8 sections, I have covered the CMA report preparation process in depth with an elaborate comprehensive case study. Then we have course number 5, how to read balance sheet. In this course, I have picked up a real life balance sheet from stock exchange and I have explained in and out of balance sheet reading process. By taking this course, you will develop confidence in reading balance sheet. Then comes course number 6, how to read CIBIL report. By taking this course, you will develop the ability to read the CIBIL report, read in between the lines, as well as read each and every line of CIBIL report and frame the credit opinion of the borrower. Then comes course number 7, how to prepare cash budget for bank loans. This course will help you when a borrower approaches you for short-term loans, ad hoc loans, or for letter of credit. So by taking this course, you will get the complete picture of cash budget with exposure to the format and solving real case studies. So it's basically 7 courses which I have introduced, and this 7 course package is what I call as Financial and Credit Analysis Mastery Bundle, and the price of this 7 courses works out to somewhere close to 13,000, but I'm going to give it at a discounted price for you today because you have attended this webinar, and the offer price what I give you is 4,990 rupees. Okay, but I'm not going to just stop with this. I'm going to give you more. I'm going to give you a lot more. I'm going to give you lots and lots of bonus. You are going to get course number 8, registration and licenses required to run business in India. It will take you through that entire process. Course number 9, how to carry out credit risk rating for non-trading entities. Course number 10, here you will learn banking credit analysis in depth once again through various case studies. So how many courses now? It's 10 courses of value close to 19,000 rupees, but you are not going to pay that amount. It's same 4,990. It means you get these 3 courses as bonus. But it is not just this. I'm going to give you some more bonus. Course number 11, financial statement analysis, a complete study. Course 12, master class on working capital management. Course 13, accounting and finance for bankers. Course 14, NPM management, a complete study. So how many courses? It's 14 courses of value close to 27,000, but I'm going to give it to you at the same price of 4,990. Not yet over, some more bonus. Here comes course number 15, where you will learn business finance secrets. So you will be wearing the hats of the entrepreneur so that you can understand the business finance secret process. Then comes the next course, finance for non-finance executives. This will be your savior if you are from non-finance background. Then we have the next course, basics of forex management, a complete study. This will save you if you're going to deal with import export customers. So how many courses now? It's 17 courses of value close to 33,000, but I'm offering it to you at the same price of 4,990. Not yet over, some more bonus. Here comes course number 18 for you, which is legal and regulatory aspects of banking, part 1 and part 2. And I'm also going to give you a course on accounting basics in 66 minutes and a course on fair practices code on lenders liability. So how many courses now? It's 21 courses of value close to 37,000, but I'm going to give it to you at the same price of 4,990. It means you get all these free, you get all these as bonus. But bonus not yet over, some more. You have the next course, that is basic elements related to bank loan proposal. This course will teach you how to write bank loan proposal. Then there is a course on credit policy, products, delivery, appraisal, risk and rating. Then you get access to the course called export finance, priority sector lending and retail loan. And you also get access to the course collateral securities, a comprehensive study. So how many courses? It's basically 25 courses, of which the 7 courses are main courses, and I'm giving you bonus. All the remaining courses comes to you as bonus because you have attended this webinar. So what is the overall value? The overall value is close to 45,000 of 25 courses. It's 3,200 plus lectures. You are going to get lifetime access to all these pre-recorded courses. You can access them in your mobile app, in desktop, and the price is close to 45,000, but you are going to get it for same 4,990, and it is not yet over, something more. I'm going to give you access to ebooks on current ratio, debt equity ratio, cash flow statement, capital structuring, financial break even, capital budgeting. So it's basically 12 ebooks you are going to get access. And I'm also going to give you access to certain e-resources. You will get access to project report template, CMA template. You will also get access to a template which you can use for planning your child's future education. And you will also get audiobook on types of financing. You will also get access to test series related to analysis of financial statements, working capital requirements, and ratio analysis. And something more, you will also get access to career guidance material which is related to professional courses for banking executives and a material on all about certified credit professional. So it's basically 25 courses of value close to 45,000, 3,200 plus lectures, 20 ebooks and resources of value close to 2,000 rupees. You get lifetime access for these pre-recorded courses and e-resources. You can access them in mobile app, desktop, laptop. Its value is close to 47,000, but you are going to get it today for 4,990 only. This is a one-time opportunity for you. Make use of this opportunity. Enroll now.
So thanks for this opportunity. I'm going to share the link. Please check your chat section. Whoever watching this in Zoom, check your chat section. Whoever watching this in YouTube, check the chat section as well as description below. I'm placing the link now, and this link is valid only for next 20 minutes. So if you want to continue your learning journey, if you want to take it to the next level, if you want to make best use of this opportunity, your time is on now. It's going to be next 20 minutes. So if you believe that this webinar has added value for you, and if you want to continue your learning journey, now the ball is in your court. Please click on the link. It will take you to the course. If you already have a student account in CA Raja classes, directly you can enroll. Otherwise, it will prompt you to open up a student account, and then you can complete the enrollment registration process. Let me also share some of the feedback given by our earlier students. Just have a look at it. If you still wonder whether you should enroll in this package or not, just look back your past 60 plus minutes you have spent. Just try to answer all the 4 questions. Question 1, did you really understood what was explained? If answer is yes, whether you are able to relate with the things that were explained in this webinar. If answer is yes, if you derived value in the 60 plus minutes, and if answer is yes, and if you had that aha moment or bulb on moment that you have learned something really meaningful, useful, then I would suggest go and enroll confidently, because you will get that throughout this package, throughout the courses. That's the assurance from my side. If you have this question as to how you can access these courses, just have a look at the screen. If you enroll now, you can access them in desktop, laptop by visiting our portal. You can also install our app. We have app for Android phone users as well as iPhone users. You can download the app from Play Store, App Store. Just search for CA Raja classes, and the courses whatever you enroll will be available in the app also. And the best part is you can download the courses into your mobile within the app, and you can access them later even without internet connection. After enrolling the course, if you have some doubts or if you need some guidance, we are going to provide you 24 by 7 lifetime support through our Telegram community. We have a community for financial analysis where 1000 plus bankers have already signed up. This is only for paid students who are coming to this specific course. You can ask all your questions and you will get reply. You can also learn from question answers of other participants. I'm also sharing the screenshot of our Telegram community. This is where most effective learning happens, because on a daily basis, there will be discussions, Q&As, and many take advantage of this. Okay. And now it's time for you to take your call. And before you take that final call, let me give you a bold assurance. Let me give you a bold assurance. My bold assurance is this package will give you at least 100 times value for the money you are going to commit. That's my assurance. You will get at least 100 times value for the money you are going to commit in this course, because that's the kind of feedback I have from earlier students. That's the kind of upskilling happened for our earlier students. Many of them have come back to me saying that they got their promotions, cleared their credit examinations, they were able to do their credit related job with utmost confidence. So it's because of such a feedback, I am giving you a high level of assurance. And for you, this is not an expense, rather a one-time investment. And what you are going to get is lifetime access to the courses. And I'm giving you a lifetime Q&A support through our Telegram community. You will not find such an opportunity elsewhere or anywhere in the market. So I'm saying it very boldly, and I can give you that assurance. So whoever enrolling now, please type I am enrolling. Please type I am enrolling, or simply type IME. IME, it means you are enrolling now. Yes, whoever enrolling now, please type IME. And Vinayak, you want to go for a 50 bundle course? If you want to go for a 50 bundle course, go ahead. Coupon per se, I'm not in a position to arrange for that. Or what you can do is just go to that course. On the top, you will see that one-to-one discount widget. Just fill the form. Then you will get coupon maybe after this webinar. Okay. And now it's time for you all to take a call. And before you take that call, final call, let me give you my assurance, my bold assurance. My bold assurance is that you will get at least 100 times of value for the money you are going to commit to this course, because that's the kind of feedback I have from earlier students. That's the kind of upskilling happened for our earlier students, and many of them have come back to me saying that they got their promotions, they cleared their credit examinations, and they were able to do their credit related job with utmost confidence. So it's because of such a feedback I'm giving you this high level of assurance. And for you, this is not an expense, rather a one-time investment. And what you're going to get is lifetime access to the courses and lifetime Q&A support through Telegram community. You will not find such an opportunity or such a platform anywhere or elsewhere. I can say that very boldly, and I can give you that assurance. And as I said, I'll keep this entire process transparent. So whoever enrolling now, please type I am enrolling, or in short, type IME. And as and when a students sign up, I'll be calling out the name of each and every participant, and I'll give my acknowledgement and assurance. Okay, so let's get started. Whoever enrolling now, please type I am enrolling. Please type I am enrolling, or in short, type IME. IME. Vinayak, just give me a moment. I'll arrange a coupon for you. Vinayak, just make use of that coupon. It is 1 DISBCB. So using this coupon, you'll be able to get into this 50 courses bundle for a price of 5,750. Is that fine? Yeah, go ahead. I'll stay back. And once you complete the enrollment, I'll give my acknowledgement as well. And whoever enrolling now, let me know. And Vinayak, are you enrolling now so that I can stay back? Okay, go ahead.